So, quick video on Crocs. I mentioned this in passing in a few other videos where I said, it's not a bad idea. I was buying it every time it dropped down to about 100 and trimming it when it would go to like 106, 107, and then just do the same thing. And I said, at like 5 or 6 times earnings, you really couldn't go terribly wrong because, like, I think it was like 8 times earnings at the time, and the market S&P 500 was like 20 times earnings. Now it's trading at about 5 to 6 times free cash flow. So I think it's really oversold. And I have now a medium-sized position in this, and I'll talk about why. So if you remember when I did the videos on Smith and Wesson, and it went up to like I think I bought around 10 or 12 bucks and sold at like 18 to 20, and so it was like a 70% return in a year. And I had gotten the idea from this guy, Norbert Liu. Norbert Liu is a mysterious guy. If you Google him, you won't even find a picture of him. There's no picture of him. He doesn't really run a fund in the conventional way. He has very concentrated positions, and sometimes he'll go like 2 or 3 years before he buys anything. And at one point he had like 3 stocks. And then he bought Smith and Wesson, and so it prompted me to take a deep dive into Smith and Wesson and Bruger and understand the industry. And then I kind of saw what he saw, and I timed it right. And he's mostly sold out of that position, and so did I. I did buy back around $10 and under, very small position after I sold the big position at 17. And some options, but I think there are better things out there. But as I said, sometimes he goes a few years without buying, and he only has a very concentrated portfolio. But this last quarter, he bought 3 things: Crocs, PayPal, and Pinduoduo. So Pinduoduo is the company that owns Temu, which people have a love-hate relationship, but that's up about 30% since he bought it. But Crocs and PayPal are still down from the end of the quarter where he bought the most recent quarter. So you would be buying it possibly cheaper than he got his shares at. And again, he's a very successful investor. Joel Greenblatt used to use his write-ups from the Value Investors Club to teach students at his Columbia business class. And out of these two, as I said, I was buying around 100 and selling around 107, 108, and just using it as a trading sardine, but it's a lot cheaper now. So why is it cheaper? It's because of the Trump tariffs. So they manufacture a lot of stuff in China and Vietnam, which have been hit with tariffs. However, those tariffs may get declared illegal, but even if they're not, even if those tariffs stay, buying it at this price with those tariffs in place, you're still getting it at 5 to 6 times free cash flow, including the tariff hit. And a lot of people look at this and they look at another beat down company called Lululemon. But I think this is better than Lululemon because Lululemon is beaten down a lot, but Lululemon is shrinking. This was a high growth company, and they bought foolishly a company called Hey Dude. And sales of Hey Dude are down like 20%. So the stock tanked, and then the tariffs came, and then it went even further. But Hey Dude, which is a fashion brand, even though that's struggling, the company as a whole is still growing like 4 to 5% a year. So as opposed to Lululemon, where you're paying a certain multiple for a company that's shrinking, for Crocs, you're paying a lower multiple for a company that's still growing. If those tariffs get declared illegal and you get that money back, this will do really well. Even if those tariffs stay in place, though, the places where they've seen real growth in Europe and India and China are small markets now, but they're growing a lot. So China grew 30% last year, year over year. People in China love Crocs. They love the giblets. And the Crocs that are being sold in the EU and China and India don't have this tariff issue that the US has. So the faster growing markets are not being hit by the tariffs. And again, you're paying 5 to 6 times free cash flow. So One thing I was doing is I was selling puts on this, which is how I got the position because I didn't have any available cash. So a put is the opposite of a call. If you buy a call in that type of option, if it goes up, you'll make money. And if it doesn't, you lose the money you put up. So you lose the option premium, but that's all you can lose. And with a put, if it's trading at 85, I could sell a put, for instance, and I would be committed to buy 100 shares at 84. And so if it dropped to 83 or 82, instead of buying it at that price, I would have to buy it at 84 at expiration. However, I would get whatever the premium was. So if I sold the put at 84 and I got $1 premium, I'm really only paying 83 for it. And so unless it got below 83, I'd still do okay. And the reason it's an interesting strategy, Warren Buffett used it when buying Coke. If I'm perfectly willing to buy this at 100 and I'm perfectly willing to buy it at 85 and I sell puts at 84 or 83, whatever money I collect, if it stays above that price, I get to keep that. And if it trades below that price, sure, I'll have to buy it, but I was willing to buy it anyway at this price. So that's my thoughts on that strategy. And I have a mid-sized position in the common. But as you can see, I owned some of the calls and I sold several puts where I get to collect that premium. And as you can see, here's a 2028 put. And you get a lot of premium for that. I got 2,600 for selling 2 shares, 2 puts. So anytime between now and 2028, if Crocs goes below $70, they can make me buy it. And if it doesn't by 2028, I'll get to keep that 2,600. And another thing that I can do, this is 2 years away, so that's okay. But this is very volatile, so you can sort of get more premium like this. This expires in a few days. So on that one, I was getting about $1 per put premium, and a put is 100 shares, so $100, and it was only a couple of weeks away. So I can just sell that, and if it expires, I get to keep 100%. So this is expiring tomorrow, and that'll be 100 soon. And if I'm forced to buy it because it expired below that price, I'm okay because I still wanted to buy it anyway. So Crocs is interesting because even though it's not a fashion brand, they're kind of just utilitarian shoes. If you do a search on Amazon for Crocs and you sort low to high, they start about $15. And then if you go high to low, they go as high as $200. And they recently came out with partnerships with the NFL, so you can buy NFL branded Crocs, and those for most of the teams, when I checked on them, are sold out. And as I said, they're growing a lot in China. And the main brand Crocs, as opposed to the company that they bought, Hey Dude, the main brand is pretty durable. They're not fashionable. I have a couple of pair and they are ugly, but they're very comfortable. I take them to the gym, and it's almost like I have a subscription to Crocs where I buy a couple of pair. When they wear out, I buy a couple more pair. So it's almost like a SaaS company, software as a service, because you have these continuing things. And I could buy something else. Nike and other companies are making things that look like Crocs, clogs, but these are comfortable. I know my size and I can get them anywhere. So when the S&P 500 is trading at a very high valuation, and a lot of the S&P 500 consists of companies that don't have earnings, or companies like Palantir, which is trading at 600 times earnings, or Tesla that's trading at 260 times earnings. When you get this company that's trading at 5 to 6 times free cash flow, it's very attractive. So you might notice here the PE says 22 and it says forward PE 8. And that looks unusual because, as you see, it's always been cheap. So here, trailing PE is 8, forward PE 8.5, 7, 8. So why is this 22? Well, they took a write down on that Hey Dude acquisition, and it's not a cash impairment, but they said, well, what we paid for this company is not worth what we thought it was. And so they took a write down on that. And under accounting treatment, that affects earnings, but it's not a cash charge. So if you actually look at free cash flow, it's very reasonable because I wouldn't look at that impairment charge as something that affects the cash coming in or the cash going out. So anyway, I have a mid-sized position in this, probably like 3% position, and I run a pretty concentrated book. I would say my largest position after the run up is Google, which is like 20%, and then St. Joe is like 15%. And but this one is good enough that I would take what I consider a mid-sized position about 3%. So I figure I could buy it at 3%, and if it grows to 5 or 6%, I would just hold on to this forever because um, Crocs doesn't seem like something such as Lululemon, which goes in and out of fashion. I think of this like work boots. They're utilitarian, and it's a very profitable company because they just make injection molded rubber clogs. And um, buying that actual fashion foot company is kind of silly because it's easier to make a shoe with one piece than that's injection molded than something that you have to sew together 7 or 8 pieces. And if you see the operating margin on this is more than you'd expect for a shoe company. And I think once the overhang from Hey Dude goes away, that this is going to look like a winner. So I'm not telling you to buy or sell. I'm just walking through my process and keeping a contemporaneous record of my thoughts when I invest in something. So this is one that I have a mid-sized position in, as I said. And what I have been doing, I have a couple of long-term puts. But mostly what I've been doing is when the price is cheap enough, because it did get down to like $77. I would just sell these short-term puts. So for instance, a week from now, October 10, 1 week from now, if I sold a put, it's trading at 85.60, but if I sold a put at 84, I would get about $1.60 premium. So 84 minus $1.60, that would put the buy price around here, 82 something. So for each of these puts that I sold, well, this is the bid and this is the ask, so it's going to be somewhere between there. But let's assume I sold it at the bid, which is $1.60. For each put that I sold, I would get $1.60, and the price is right here. And if it didn't drop below 84 in a week, I would get to keep that 160. And if it did drop below 84, I might be forced to buy it. But if I liked it enough to buy it here, it kind of looks like a good idea to me. But options are very risky, so I would learn what I could about investing with common stock only, no leverage, and then eventually move on to options. So I've been investing for like 20 years now, and I avoided options while I was in the government because there's ethical rules against buying puts or selling puts, and I didn't want to get in any trouble. And I've just dipped my toe in recently. So even with 20 years experience, it's something that I tread carefully on, and so I definitely wouldn't recommend it to everyone. I'm just, again, walking through my strategy and keeping a contemporaneous thoughts of my actions so that I don't fall subject to thesis drift. So that's what's going on with Crocs and why I started buying in quantity instead of just using it as a trading sardine as I was before. And I'll try to do some more videos if you guys are interested. Leave some comments on ones you'd like to see. Another one that Norbert Liu bought is PayPal, which I also have a medium position in. I think it's really interesting. And Pinduoduo, which owns Temu. So if you're interested in those, leave a comment. I think I've mentioned Table Track in passing. I have a small position in this. And I have 3 accounts, and there's only one where I can trade this because it's so small that I can't trade it in 2 of my 3 brokers. And I have 3 brokers for that reason, because sometimes I can trade one with one and I can't trade it with another. So for instance, these preferred shares, I can buy them in Merrill, but they're not available in Schwab or Robinhood. Whereas this is not available in Merrill or Robinhood, but it is available in Schwab. And it's a very small company, only 21 million. But it's a specialty software company. They make casino management software for casinos. So if anyone's interested, I can do a video on that. But anyway, like and subscribe, and just leave a comment below on anything you're interested in. And there's a Buy Me a Coffee if you want to help support the channel, but don't feel like you have to. And have a great day, everyone.